So in part one, we took a hard look at the unsexy truth of American wealth. Not the crypto casino, not the day train lottery ticket. We looked at the laundromat, the car wash, the self-storage facility, the boring, reliable machines that mint millionaires while the rest of the world is asleep. But there's a glaring omission in that first act, isn't there? How do you actually buy the machine? We briefly touched on it, but now we're going to be taking a deeper dive. Enter the Small Business Administration, or SBA 7A loan. It's the single greatest wealth creation tool the federal government offers the average American, and it is also, if you squint at the fine print in the wrong light, a beautifully designed trapdoor. The Small Business Administration doesn't give you the money. They just promise the bank they'll cover between 75 and 85% of the loss if you default. That guarantee makes bankers suddenly very interested in funding your dusty car wash project. It's the grease in the gears of the boring wealth machine. I've spent the last few years talking to SBA loan officers, forensic accountants who clean up the messes, and business owners. Some of those business owners own yachts. Some are now in bankruptcy court. And they all agree on one thing. The devil isn't in the interest rate. The devil is in the prepayment penalty, the collateral shortfall, and the life insurance policy you didn't bother to read. On paper, the 7A loan is a miracle. Let's say you find a laundromat for $800,000. It nets the owner $160,000 a year. But here's something mostly 2POs skip. You don't just write a check for 10% and the bank covers the rest. An SBA acquisition is almost always a three-legged stool. Leg one, your down payment, 10 to 15% of the purchase price. Leg two, the SBA loan itself. That's the bulk of it. And leg three, this is the one that surprises most first-time buyers, the seller dough. The current owner usually has to leave 10 to 20% of the sale price in the business. They become your lender. They get paid back over time, with interest after the bank gets paid. If the seller demands 100% cash at closing and refuses to carry a note, the SBA deal often dies right there. The bank looks at the structure and asks one question. Can this thing pay us back? They use a metric called debt service coverage ratio, or DSCR. It's a fancy way of saying, does the business make more cash than the loan payment? The SBA minimum is 1.15. That means the business needs to generate 15% more cash than the loan payment. But in the real world, most banks won't touch a deal below 1.25. In our Laundromat example, we're at 1.36. That's healthy. That's financeable. That's the boring wealth machine in motion. Other people's money doing the heavy lifting while you fix broken dryers and collect quarters. But here is where Pulitzer Prize-winning journalism requires us to stop polishing the hood and look at the engine sludge. That $9,800 payment, it doesn't care if the Department of Transportation closes your main road for 6 months or longer to replace traffic lights. It doesn't care if the boiler explodes in January. And most importantly, it comes with a set of handcuffs that you agreed to wear on page 47 of the closing documents. Before we get into the exit traps, we need to talk about the entry fee. Because getting into this deal costs money you never actually see leaving your checking account. It's called the SBA guarantee fee. Remember how we said the government promises the bank they'll cover most of the loss? That promise isn't free. The SBA charges you an upfront fee for that insurance policy. For a loan over $2 million, his fee can reach 3.75% of the guarantee portion. On a $2 million loan, you're looking at a fee of $50,000 to $60,000. Here's the part nobody explains at the Chamber of Commerce breakfast. You don't write a check for this. The bank adds it to your loan balance. You borrow the money to pay the fee for borrowing the money. It's compound interest's obnoxious cousin. And it means the moment you sign, You owe more than the business cost. And let's talk about dig keeping. The SBA guarantee doesn't mean anyone gets a loan. There are hard stops. First, your credit score. Lenders typically want to see a FICO score north of 680. You can sometimes get in with a 660, but you'll pay a higher rate and face more scrutiny. Second, and this is the silent deal killer, industry experience. If you spent 20 years as a software engineer and you suddenly want to buy a commercial laundry, the underwriter is going to squint at your application. The SBA wants to see some connection to the business you're buying, management experience, a partner who knows the industry, or a detailed plan to retain the existing manager. Walking in cold is a fast track to a denial letter. So, you got the credit, you got the experience, you swallowed the $60,000 guarantee fee, you're in. Now, let's look at the traps waiting for you on the other side of that gate. Pitfall number 1, the prepayment penalty hostage situation. In standard commercial loans, if you want to sell the business or refinance for a better rate, you just do it. But the SBA 7A program comes with a unique feature designed to protect the secondary market, the place where these loans are sold to investors. It's called the prepayment penalty. The standard is 531. If you pay out the loan in year 1, you owe a penalty of 5% on the entire loan. Year 2, 3%. Year 3, 1%. Here's the journalism part. If you sell the business for a profit in year 2, that penalty applies to the loan payoff and not only your profit. I spoke with a broker in Ohio who had a deal collapse last month. Seller had $2.4 million SBA loan on a car wash. Buyer offered $3.1 million. Great, right? But because they were in year 2 of the loan, the prepayment penalty was $72,000. $72,000 in cash just vanished. The seller's net equity was so depleted by this fee that they couldn't afford the capital gains tax on the sale. So they had to stay in business that they were ready to leave. That is the opposite of a wealth machine. Pitfall number 2, the life insurance clause you ignored. When you take an SBA loan over a certain threshold, usually around $500,000, the bank is required to secure key person life insurance. You are the key person. You think, fine, I'll get a term policy for $500,000. But here's the trap: collateral assignment. That policy doesn't pay out to your spouse or kids first. It pays out to the bank to satisfy the SBA loan balance. The rest, if any, goes to your family. That's fine if you just want the debt cleared. But where'd you have a business partner? What if your spouse was counting on the business plus a life insurance to survive? In the boring wealth machine world, you are the CPU. If the CPU fries, the bank takes the entire hard drive to the scrap heap before your family gets the data. And this brings us to pitfall number 3. This is the one I see ignored most often on YouTube Finance Bro channels. The SBA lien on everything guarantee. The SBA loan requires a personal guarantee. That's standard. But many first-time buyers don't realize the extent. For a standard 7A loan, if you own a house with more than 25% equity, they want a lien on it. That a brokerage account, they want a lien on it. You are not just buying a laundromat. You are hitching your entire net worth to the soap, suds, and spin cycles. People always ask, well, can I hide my house in an LLC to avoid the lien? The answer is usually no. If you're the 100% owner and you have equity, the SBA standard operating procedures say the lender must take the lien unless they get a specific waiver, which is getting harder to get every year. You are the collateral. Okay, so you might be thinking, why would anyone ever do this? Because when navigated correctly, leverage is still the most powerful force in finance. The key is to go into the bank with the same level of intelligence they have on you. 1. The prepay penalty. It is negotiable. Not with the SBA, but with the lender. Some lenders will offer a step down of 3-2-1 instead of 5-3-1. Some will waive it if you refinance with them. This is the question you must ask. If I want to sell this business in 18 months, what is the exact dollar amount of the fee I will owe you? If the banker stutters, then you have the wrong banker. 2. The life insurance. Before you sign the collateral assignment, call your estate attorney. Ask them to structure a split dollar agreement, or simply understand that your family gets the excess proceeds. Know the math. 3. Stress test the DSCR. When the bank shows you that shiny 1.25 coverage ratio, remember, that's based on historical numbers. Ask for a sensitivity analysis. What happens to the DSCR if revenue drops 10%? What if the minimum wage goes up? What if a competitor opens up across the street? If the DSCR falls below 1.0 in those scenarios, you are one bad month away from a capital call. And 4. The 20% rule. This is the metric that separates the owners who sleep well at night from the ones who don't. The data is clear. If your projected SBA loan payment is more than 80% of the business's current net operating income, you are a speed bump away from default. You need a 20% cushion for the roof leak, the minimum wage hike, or the competitor across the street. I put together a free spreadsheet calculator for this exact SBA stress test. It includes a DSCR calculation, the guarantee fee impact, and a prepayment penalty forecaster. It's not fancy, but it works. Link is down in the description below. Download it, use it if you plan to go into this kind of business. The goal of the Boring Wealth Machine is not to make you the next hottest TikTok star. It's to make you unfireable. It's to create an asset that spits out cash while you go coach your kid's soccer team. But that asset can become a liability the size of a house if you ignore the terms of the deal. Here, we're building a community of people who read the fine print before they sign it. If that sounds like you, hit that subscribe button. And if you know someone about to sign an SBA loan for a laundromat, car wash, or any other small business, send them his video. It might save them $72,000 or $60,000 or their house. In the next installment of Boring Wealth Machines, we're tackling the thing that keeps the small business owners chained to the front counter, the myth of the hands-on owner. Next time, we'll be discussing automation to alleviate you from the responsibility of owning a second full-time job, specifically the low-cost, high-impact technology that separates owners who take vacations from the owners who are the business. We'll look at remote monitoring systems for laundromats, automated payment platforms, eliminate cash theft, and the one piece of software that turns a 40-hour work week into a 4-hour oversight check for a self-storage operator. I know. It's about reclaiming your time without sacrificing your profit margin. Further down the line, we'll answer the question that keeps every successful, boring business owner up at night. How do I keep what I've built? The Boring Wealth Machine is a long game, and the next level is learning how to step back without the machine breaking down. Hit subscribe so you don't miss it. Thanks for watching. And if you're a company that wants to reach business owners who are actually doing the work, people buying laundromats, car washes, and warehouses, there's a contact in the channel description. Let's talk.